Assalamualaikum warahmatullahi wabarakatuh to Syaril. Before that, my name is Mohamad Azzmal bin SAZALI. My meeting number is 264813. So today our group 5 will present about the foreign exchange market. In this presentation, we will present about the concept, characteristic, structure, and mechanism of the foreign exchange market, the global foreign exchange market, practice in Malaysia foreign exchange market, exchange control regulation, and risk in foreign exchange transactions. So my group member will present about it and start with the concept foreign exchange markets.
Hi, Assalamualaikum. My name is SAKINAH. My metric number is 280993. Today I'm going to present the concept of foreign exchange market. The foreign exchange is the exchange of the currency of one country from the currency of another. The foreign exchange market is an arena through which one is able to transfer purchasing power from one country to another. Exchange markets is the market where the forex rates are determined, is a virtual and operates around the clock 24 hours a day. The volume of foreign exchange transactions is very large. They are made up of banks, forex dealers, commercial companies, central banks, investment management firms, hedge funds, retail forex dealers, and investors. The characteristic and structure of the foreign exchange market. The first one is high liquidity. It is the most easily liquefiable financial market in the world. This includes the trading of numerous currencies all around the world. Secondly is market transparency. Foreign exchange dealers have complete access to all market data and information. This will help to monitor different country currency price fluctuations through the real-time portfolio. Thirdly is dynamic market. The currency values change every second and hour. And lastly is operates 24 hours. The foreign exchange market functions 24 hours a day. This provides the trader the possibility to trade at any time. The major foreign exchange market consists of 5 markets. The first one is spot markets. The spot market, in this market, the quickest transactions of currency occurs. This foreign exchange market provide immediate payment to the buyers and sellers as per the current exchange rate. Second market is forward market. In the forward market, there are two parties, which can be either two companies, two individuals, or governmental agencies. In this type of market, there is an agreement to do a trade at some future date at a defined price and quantity. And thirdly is future market. The future markets come with the solutions to a number of problems that are being encountered in the forward market. Future market works on similar lines with and basis philosophy as the forward markets. Fourthly, the option market. An option is a contract that allows an investor to buy or sell instrument that is underlying, like a security, ETF, or even index at a determined price over a defined period of time. Buying and selling options are done in this type of market. The last one is swap markets. A swap is a type of derivative contract through which two parties exchange the cash flow or the liability from two different financial instruments. Most swaps involve this cash flow based on principal amount. I will present the functions of foreign exchange market. The first one is transfer function. It's the basic and most obvious function to transfer the funds or the foreign currency from one country to another for settling their payment. And the second is credit transfer. The forex provide short-term credit to the importers in order to facilitate the smooth flow of goods and services from various countries. The importer can use his own credit to finance foreign purchase. The last function of foreign exchange market is hedging function. The parties in the foreign exchange are often afraid of fluctuations in the exchange rates, which means the price of one currency in terms of another currency. This might result in a gain or loss to the party concerned. Last slide, I will present the participants of foreign exchange market. There is 5 participants. The first one is central bank. Central bank control the money supply in the market and ensure that the exchange rate fluctuate within the desired limit. Second participant is commercial bank. It facilitates international trades and exchange to its customer. It provides foreign investments. Third participant is traditional users, consists of foreign tourists, the company who carry out business operations across the globe. And fourth participant is traders and speculators. It is the opportunity seekers who look forward to making a profit through trading on short-term market trends. Lastly, the brokers. The brokers considered to be the financial expert who act as a sure intermediary between the dealers and the investors by providing the best quotations. That's all from me. I will pass to the next presenter.
Assalamualaikum. My name is Muhammad Azzmal bin SAZALI. My meeting number is 264813. So I will explain about the global foreign exchange market. So for the first point is industry trend. During the period 2021 until 2026, the worldwide foreign exchange market is predicted to grow at a CAGR of 7.5%. It's the world carefully monitoring and analyzing the pandemic direct and indirect effects, keeping in mind the risk of COVID-19. As a prominent market contributor, these insights are incorporated in the research. Next, I will explain about the use of foreign exchange markets. It's performed through credit instruments such as bill of foreign currency, bank draft, and telephonic transfer. The fund transfer transaction through an electronic network of banks, financial institutions, brokers, and individual traders. Forex also find extensive application for transferring funds to support the exchange of various goods and services between the nations. Last is the growth and opportunity in the global foreign exchange markets. Growing urbanization and digitalization in both the emerging and developed economies and are among a key factor driving the growth of the markets. Furthermore, the availability of the electronics platform and the provision of improved security mechanism for trading are also providing a boost to the market growth. Next, I will explain about the benefit of use the forex markets. First point is a large market. As the world's largest financial markets, in excess of 4 trillion USD is exchanged on average per day. Traders in all corners of the world are buying and selling currency based at all hours, making a forex a truly global marketplace with plenty of scope for profitability. It's the breadth of the market that contributes to many of the benefits of forex trading, including accessibility, liquidity, volatility, technology, and trading hours. Second point is good for beginners. This is because free demo accounts allow you to practice trading forex without risk, and essentially providing a try before you buy test runs. By simulating a live trading environment, demo account give you the chance to get used to a trading platforms, familiarize yourself with the market movement, and develop a risk management strategy, all without making any financial commitments. So that's all from me. Thank you.
Assalamualaikum and hello everyone. My name is SYAFIQAH binti AZRIN. My matrix number 272060. Okay, I will explain about the practice in Malaysian foreign exchange market. Malaysia switched to a managed float exchange rate regime in July 2005 after pegging the ringgit to the US dollar following the ASEAN financial crisis of 1998. In this system, the ringgit is pegged to a basket of the country's key trading partners' currency and is free to fluctuate in response to market force. Since then, central market intervention has been limited to preserving orderly foreign exchange market conditions in order to avoid ringgit exchange rate extreme that could destabilize the real economy. As at this time, the foreign exchange market was less developed with only a limited range of hedging tools. The intervention served several purposes. For the first point, central bank in Malaysia not only offers stability to the entire market and the real sector by smoothing exchange rate movement with a gradually increasing tolerance of increased volatility, but they also help market players build risk management capacity. Next, central bank also focus more on addressing periods of market dysfunction. Experience has shown that portfolio flows are the main factor influencing ringgit volatility, given that such flows are often variable, short-term, and sensitive to market news. When inflow or outflow have reached extreme level, the central bank has intervened with the aim of mitigating volatility, maintaining orderly market functioning, and reducing any destabilizing effect on the real economy. In all cases, the decision to intervene has hinged on whether the financial market are judged capable of intermediating this excessive flow. The fourth point are the central bank intervened to moderate the sharp depreciation pressure on the ringgit. Malaysian interventions were relatively effective in moderating excessive exchange rate volatility by providing two-way flow, other one of the Malaysian foreign exchange market practice. Moreover, fostering an open and close relationship with market players for surveillance purposes is an important tool in anticipating changes in market sentiment and gauging the intensity of capital flow, in addition to engaging continuously with market participants when assessing early warning indicators. And the last one is central bank also track cross-border flows via a monitoring system that provides near real-time information. The system captures details of flows across local financial markets, including volumes, the instrument involved, and the nature of transaction. This provides the central bank with the information needed to manage capital flows. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is NURUL binti HAZARI. My metric number is 275454. Now I will present about the exchange control currency. What is exchange control? Exchange control are government imposed limits on the private foreign currency transaction. Exchange control is used to manage or avoid a negative balance of payments on the national accounts. It includes directing a country's foreign currency earnings into a central bank control pool. There are a few objectives of exchange control. First is to protect the value of the national currency. Control foreign exchange trade is the government's approach of keeping the exchange rate a desired level. The government might set up a fund to protect currency volatility or fix it at a predetermined rate to achieve its goals. Second objective are restore the balance of payment equilibrium, realign the BOP when it's a deficit owing to more import than export. It is reducing import to basics and boosting exporter by devaluing the currency. Next is a build of foreign exchange reserve. The government may want to increase our foreign exchange reserve to maintain the local currency, pay off international debt, and cover imports. Last objective is protect local industry. The government may use a currency control to safeguard domestic industry against overseas competitors who may be cheaper and more efficient. It mainly involves increasing local export, import substitution, and limiting foreign import through import quotas and tariff. Okay. There are two methods of exchange control. First is unilateral method and second is bilateral method. In unilateral method have exchange of pegging standstill agreement, compensation agreement, payment agreement, foreign exchange rationing and blocking exchange. In exchange pegging, this refers to the policies of fixing the exchange value of the currency according to the sub-reserve rate. In standstill agreement, it was a relationship between two countries in terms of capital movement remain unchanged. The debtor country is allowed to repay loan in installment or the short-term loans. Next is compensation agreement. This agreement goods of the equal value are exported and imported from each other country. For payment agreement, this method creditor country will export more and more to debtor country, and the creditor will import less and less from the debtor country to settle the account. Next is a foreign exchange rationing. The government has the right to direct all the exporter and other investors to surrender all foreign exchange with the central bank. Foreign exchange can be retaining by fixing quota, the amount and the rate of foreign exchange. And lastly is a blocking of foreign exchange. During the emergency, a country may block a foreigner to transfer their funds in their home account. Okay, next we move to the bilateral methods. In bilateral methods contain clearing agreement and moratorium application. In clearing agreement is when two countries agree to settle their account in their home countries through the central bank. And the moratorium application is a legal authorization to debtor to stop payment and is used to temporary problems of payment. A country will stop payments for imports and interest on capital. That's all from me. We move to the next presenter.
Hi, Assalamualaikum. My name is Putri ROZIRA binti MOHAMAD ROZNI. My metric number is 275646. Okay, so today I will talk about foreign exchange transaction. Okay, in any foreign transaction, each party must be clear about 6 elements. The first one is commodity currency, which is the currency that is to be sold and purchased. The second one is the reference currency, which is the currency that gives the value to the commodity currency. The third one is the rate of exchange, the value date, the amount of money to be exchanged, and the last one is the parties to the exchange, which is when the buyer buys what currencies and the seller sells what currencies. Next, what is currency risk? Currency risk can be defined as the vulnerability of the institution to the changes in the rates of exchange of foreign currency. For example, institution profit or loss and its net asset value may be affected as the result of fluctuation between foreign currency and its home currency. Such movement can have a serious negative impact on financial health of an institution. Next is about risk takers and risk avoiders. Forex traders normally have an interest in high volume and prefer big fluctuation in exchange rates that can help them increase opportunity for making profit, while commercial users prefer more stable exchange rate because volatility certainly increase his business risk. Therefore, different group of users have different appetite towards currency risk. The third major risk is economic risk. Economic risk is also known as a forecast risk. It is when the company's market value is impacted by the unavoidable exposure to exchange rate fluctuation. Such type of risk is usually created by macroeconomic conditions such as geopolitical instability, and or government regulation. So the first one is transaction risk. Transaction risk is a risk faced by a company when making financial transaction between jurisdictions. The risk is the change of exchange rate before transaction settlement. Essentially, the time delay between transaction and settlement is a source of transaction risk. Transaction risk can be mitigated using forward contract and options. The first example of transaction risk is the sales made of foreign currency. The second one is payables of foreign currency. The third one is the contracts of foreign currency. And the final one is the foreign currency borrowing or investment. The second major risk is translation risk. Translation risk is also known as a translation exposure, which is referred to a risk faced by a company which is headquartered domestically but conducting a business in a foreign jurisdiction. It happens when which the company's financial performance is donated in its domestic currency. The translation risk is higher when a company holds a greater portion of assets, liabilities, or equities in a foreign currency. For example, balance sheet translation and profit and loss account translation. Next, I will talk about the major currency risk. When currency moves, institutions are exposed to the risk above, which is transaction risk, translation risk, economic risk, and trading risk. The last one is trading risk. In trading risk, there are 5 major types of risk in this category. The first one is market risk, which is due to the price direction and volatility. The second one is credit risk, which is a failure of counterparties to settle contractual obligation. The third one is liquidity risk, which is the inability to unwind existing exposure. The fourth one is operational risk, which is the impact of non or wrong settlement or lack of proper documentation. And the last one is legal risk, which is a legal contractual obligation of counterparties.